Yields on the 10-year Treasury are inching even closer to 5% on fears that stronger than expected data could drive the Fed to keep rates higher for longer. But more than half of investors surveyed by Bank of America say that they expect yields to fall within the next 12 months, the highest share of respondents on record. So why are they so certain? We want to bring in Yahoo Finance's Josh Schaefer joining us now. And Josh, I know you've been digging into this. So what's the thought process behind that? I guess, why do they see a chance here that yields could come back from that 5% level?
Yeah, Shauna, we've been talking a lot about yields at 5%, right? And so I was curious and sort of awestruck with the amount of people that think that it's going to come down. So when I talked to the Bank of America strategists behind this note about sort of how they deduced what investors were telling us there's really two paths that bring down yields, and these two paths are very different. One is a soft landing and one is a hard landing ending to the Fed's path. When you take a look at that soft landing path, that's sort of where some believe we could be headed now. Inflation hits its 2% target. We don't go into a recession, and the Fed is done hiking. This is a key part of this thesis because we know that yields often peak when the Fed funds rate peaks. If the Fed funds rate is currently at peak, then yields might be peaking right now. But there's another side to this argument that also sees yields going lower. This would be a hard landing. And in a hard landing scenario, the economy goes into a recession. What happens when we go into a recession? Once we get to that point, the Fed would likely want to cut. I should also note this is partially why we suspect some bond investors might not be coming to the market right now and buying up bonds would be if we are going to see that hard landing, maybe the economy is too hot, maybe the Fed has to hike again. And remember what I said, yields usually peak when the Fed's funds rate peaks. So right now, if you're an investor that thinks the Fed's going to hike again, you could get a better yield most likely on the 5, the 10-year, maybe even the 30-year in a month or two if you think the Fed is going to hike again. So that's sort of the key differentiator right now. But harder soft landing, yields might come down in the next 12 months, guys. We're just going to have to wait a little bit.
Yeah, here's hoping. What could drive yields even higher? You started to touch on this a little bit more. What are some of those factors?
It's the Fed, Brad, right? It is the uncertainty in what the Fed is going to do. Right now, you could ask one strategist if the Fed should hike again, and they could say yes. They could say, look at that retail sales report. Look at the jobs report. The consumer's too strong. The Fed needs to restrain this economy. You could ask another strategist, and they should say, you know, I think lagging monetary policy is going to come into play here. Credit tightening is happening, and the Fed has done enough. They just need to wait. Right now, if you look at the January Fed meeting, there's about a 50-50 split on if the Fed will hike rates again in January, or will have hiked rates by that January meeting. And it's that uncertainty that is bringing volatility into the bond market, strategists have told us. And right now, I don't see a lot of certainty coming to the Fed's path. Maybe you guys do. Maybe Jerome Powell will give us some at noon today or a little bit more. But until we have certainty in where the Federal Reserve is headed, investors do not think we are going to lose any of this volatility in the bond market.